My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is David Nicoski, who's the tech class at Vermilion Research. Now, David and I have been going back and forth with some tweets, and I feel like we're very much in sync in the way that we're seeing markets here. But first time that we formally talk like this, David. So before we get too deep into markets, introduce yourself. Who are you? How'd you get interested in markets, and what are you doing at Vermilion?
Well, I'm a technical analyst. My father was a very well-known technician on Wall Street for many years, worked at Piper Jaffray, worked with Steve Leuthold in the early 70s, and anyone that's been around since that time, which is probably eliminating 95% of the people in the room. So he went through the bear market of 73, 74. He was an industrial analyst and having a lot of his companies trading less than the cash value on their balance sheet. And he said there's got to be something more to the market. And him and his boss, which was Steve Leuthold, developed a technical product that looks at the market from a sector and group standpoint, but it's proprietary groups and groups not using the JIX codes, SIC codes, where you have someone in the back room at a company that designates what they think it should be, and instead, develop their own group work structure, calculate them on an unweighted basis versus a weighted basis, but break it down by large cap, mid cap, and small cap where you can do so. So my father worked at Piper and became the head strategist for many years. The team went on. I had been there as well. The team went on to get 9 II rankings, first at Piper ever, and 3 best of the best, which put us second to Ed Hyman at the time. My father left, and I was there and left in 2005 and started Vermilion. So I've been doing technicals for a little over 35 years. As a kid, he would bring home the charts, and I'd have to do them by hand and mark them up. So that's kind of what got me started in the industry, and been doing it ever since.
So I wasn't aware that of your father being in the industry as well. I've tweeted out multiple times that my father had worked with Bob Farrell, and
yes,
a lot of my own upbringing was just by osmosis, right? Hearing him talk about markets to my mother. When you were a kid, how were you perceiving what your dad was doing? Because I think it's when you grow up in a where your parents are in an industry where there's a degree of randomness, it makes for an interesting understanding of the way the world works in your formative years.
Absolutely. You got to go to college and you're taught about fundamentals and how the world actually behaves, versus fundamentals. The behavioral aspect of the market, to me, is much more significant. And I think the market is dominated by behavioral versus reality and what we learn. And I'm not saying fundamentals aren't important, but it's the behavior pattern of people that makes stocks go up and down as well. And I think that's a factor. When I see fundamental analysts coming out and saying, a stock is 20 times sales and it's cheap, I'm like, I don't remember studying that. I don't know where Wall Street goes wrong every decade, where these types of behavior comes in and they, project that, I remember Qualcomm back in 2000, someone did the math on it and said for Qualcomm to reach the $1,000 price target, you'd have to sell 8 phones to every person on the planet, regardless of where they live, whether they're Aborigine or live in the Arctic Circle. And I'm like, how does someone digest that? It's, and every bubble is like that. And, we are getting through a bubble that's much like, has similarities to a lot of different time periods in the market, but they're all different. They're all unique.
Do you miss those days of looking at charts in a chart book versus a screen? I mean, I feel like you can get much more close to actual price action on paper than when it's digitally presented.
Oh, absolutely. And the markets move so much faster nowadays. Myself and my team go through, over 3,000 charts of individual companies every week and put it out into a grid pattern, focusing on sector, bottom fishing, positive developing, positive trending, pullback opportunities, negative inflections, downtrends, and then toppy patterns. So we break it up so that you can look at a grid and see which sector is the most healthy in terms of what names you should be looking at from a bottom fishing or positive developing. That would be names with, formidable bases on a 2-year chart. So we're just looking at the 2-year charts, trying to capture market movement, over a shorter period of time. But, all the long-term charts are the most important. So go from long-term to, midterm to short-term to get an idea of where the price structure is.
As you were growing up, were there certain books that stood out to you that you were maybe reading at a younger age? You sound a little bit like in your journey, a little bit like mine. I was increasingly more obsessive around markets. I'd read Edwards and McGee when I was like 14 or 15 years old, and these kind of old school, technical analysis books, which I don't even know if you can find them as easily as you could maybe 15, 20 years ago. What were some of the things that you had read and studied as you were growing up, not only in terms of learning from your father, but from others that were, sort of gurus at the moment?
Well, I mean, there's so many books out there, and some of them were great analysis at the time. I would say probably one of my preferred books, and for a market like this, is more of a John Murphy intra-market analysis. The confluence of looking at currencies, and how it impacts the market is, to me, much more significant in today's market versus looking at a Pring book from the 50s. Although very well written, and the practice remains the same, we're given so much more to look at today that was not available in a nice publishable format. It's much like when I was marking up sector group charts as a kid. You're marking them up by hand. It was very intensive to sit there for hours on end, marking the high, low, and close for a week, because we all of our long-term charts are plotted on a weekly basis, for instance. But it was just time consuming. But yes, it gave you a much better feel of the market. I think there's so many facets that lie outside of technical analysis when you look at something like the FTX for today. And not that I stare at cryptos, but it's counterparty risk, and it's looking back at other periods in time, like Lehman, Bear Stearns, who was the counterparty risk. So it's only something that you can understand just from being in the market for the a period of time. You can't learn everything about technical analysis. I like to think I'm a student every single day.
Yeah, and that's the real power of intermarket analysis, which I don't know if that many people really understand what that is. Talk about for the audience what exactly intermarket analysis is and how it differs from traditional charting or traditional technical analysis.
Well, it's studying the relationship of currencies and commodities and how they may or may not impact an industry. Right now we have obviously everyone can look and see we have a very strong dollar. How is that impacting our markets? I've gone on a lot of Twitter spaces, and people, a lot of people are just simply day trading and doing options, and that seems to be the livelihood nowadays. But seeing how it impacts the longer term relationship of foreign countries, whether one area I liked, for instance, was Brazil, and after the election, I kind of shunned it a little bit and said I don't even know how to react with this, because it's not the outcome I think that would make me more favorable to Brazil. But you have the currency, has a descending top. It could be a bullish flag, but it certainly hasn't broken out, even with the Fed hike. So, there's signs that we're starting to prop up the emerging markets. And, when everyone wants to look at the US dollar index, and, if you study the history of it, it was developed in the early 70s. I want to say 71, 72. It's only changed once since that time period. And that was when, you moved away from the individual country currencies to the euro. But in essence, it's contrived of the same exact countries it did since 1971, 72. So it's my belief that there's other countries outside of that US dollar index that are likely to break first. I think we're the best house in a bad neighborhood with the currencies in that particular index, and you're starting to see those cracks. The Mexican peso is stronger than the US dollar for the last 2 years. Mexico's breaking a 12-year relative strength downtrend. Korea is breaking its uptrend. The Czech Republic is actually coming out stronger here. in the last few days. But again, you aren't going to see that in the U.S. dollar index. So I think it's important to, realize what the index that you're looking at, what it's actually measuring. I get a lot of flack from people discussing the S&P 500, and one of the fallacies is it's a managed index. It does, if you looked at the names that were in there in 2000 versus today, it's somewhere around 40%. And it's not looking and comparing the S&P of 2000 to today is really not an accurate assessment. It's like looking at the Dow and realizing they moved ExxonMobil out and put CRM in there. The Dow would be at virtually new highs right now if they didn't add CRM. So, I like to look at long-term charts. The charts that we use don't have survivorship bias. So I'm looking at, charts of the energy sector with Enron still in there. What does a bubble look like? What are the reactions, the behaviors of investors during those time periods in which you do have blow-offs and meltdowns? And to me, that's very understanding or very powerful to understand the implications of that. And especially when you look at today's market, you're getting names like Upstart reported after the bell down 25%. The stock was somewhere around 350 and we're now trading at 15. But if you can capture that in a chart throughout history within a group and see these phases of the market, it gives you something to, at least it gives you some knowledge, how bottoms are made. And they're made through time, and it's a process. And that process is going to go on until it doesn't. And, markets make bottoms unhappy. You had a great call there, Michael. I was right behind you on that call. I didn't call it to the day, but I noticed a diamond pattern on the S&P. And I said, if this breaks to the upside, I can name 7 diamonds that I've actually highlighted. And diamonds are quite rare. It's not something I do, on a daily basis, weekly basis. I think there's 7 in the last 35 years that I've highlighted. 6 of them actually proved to be correct. One of them was not it wasn't a diamond top, but again, I say this is the pattern. If it breaks to the bottom side, we're going to plunge. If it breaks to the upper side, we're going to go up. So I thought, we were going to have a top, and, it reversed, and within a few weeks, it reversed again and went straight down. So it depends on, again, there is an art to drawing lines. They don't always do what you want, but you have to, accept, hey, I'm wrong right now, but keep in tune with what changes might occur.
Yeah, and also, so I didn't say that. I didn't put that tweet out October 2nd haphazardly. The real tell for me, and you're a CMT chartered market technician, so this probably sounds a little bit familiar, but the real tell for me was utilities the final week of September. So utilities in the final week of September had one of their biggest spreads on the downside against the S&P, meaning utilities were dramatically underperforming, complete collapse on a ratio basis. And utilities are one of the key indicators in my world because the 2014 Dow Award Intermarket Approach to Beta Rotation documents going back to 1926 when utilities outperform the market. That's a risk-off period when they're underperforming, and especially when after a prolonged downtrend in broader averages, when you see defensives really get smacked underneath the surface, right?
Yeah.
People are so busy looking at the broad averages, they're not seeing that underneath the surface, the defensive areas are actually going down more. That typically marks a short-term bottom.
Absolutely.
The key there, and this is what's also been so strange about this year, I want to get your thoughts on it, is usually when you have defensive sectors leading, most notably utilities, followed by staples, and then healthcare, I would argue, is a distant third. Usually you see Treasury strong, right? This year it's been the opposite. And that's because, those dividend plays, the utilities in particular, are a bond market proxy. So I've made this point before, right? If you expressed risk off as utilities this year, you would have destroyed expressing risk off as treasuries this year, even though usually treasuries perform way better than utilities in a big drawdown, although they both behave risk off. But real quick, I want to go back to the dollar for a second before we expand on that. I have to say, I'm amazed how, and I don't know if it's just a function of, to your point, a lot of options trading and short-termism, but I'm amazed at how people don't seemingly understand that the dollar is not an asset class, in the sense that I've seen so many people tweet out charts showing channels and showing these long-term trends and projections on the dollar, but somehow people are forgetting that the dollar or currencies are mean reverting.
Absolutely.
Right? It's not like it's not like buying whole for stocks. I mean,
Yep.
if it's gonna be like that, we're all in trouble.
Absolutely. I would agree with that. It's mean reverting, and it's as extended from the 200-day, any measurement you want to take. In 2000, it did go to an extension much, greater than what we are now. We were in a tech bubble here, but I don't want to say it was to the same degree of a tech bubble, but we are in a tech bubble. It is cyclical, and people forget that. You can go on a multi-year run when you have interest rates at zero, and move that, that bar up several notches, and then you have problems. Your growth stories are not growth stories, and companies without earnings are only going to lose more. And as we lose more of these zombie companies, you're going to see that those companies that were zombie companies and how much they spent in the technology arena, that's going to disappear. You are not going to have ongoing revenue from it. And that's the same thing. You went through multiple compression for years after the tech bubble. The old economy took off. I recall sitting there in March 1st of 2000. The Tiger Value Fund, largest value fund in the world, hung it up. They just literally said they're closing it down because everything they owned was going, vertical down, right? Parabolic downtrends in the value stocks. By March 9th, that was the tech top, and boom, if Tiger Value hadn't shut their doors, they probably would have printed the best year they've ever had in their entire existence. And it's things like that that really make you look back and go, when is the last person out? And the old economy stocks did well up until 2002. April 12th of 2002, we put a piece out. The dollar was breaking its uptrend, and at that time, it took a couple of years for the dollar to make a top after 2000. When that dollar did slide, and it slid fast, you had a huge repatriation into foreign markets, because most of them were decimated, but they did not enjoy the upside like the U.S. had. I think my biggest concern right now is I don't want to see the dollar go into a precipitous slide, because that can certainly, force foreign investors to sell anything they can. And that includes all the U.S. large cap stocks. And that's what happened in April of 2002.
Yeah, and actually this point about old economy is another really big tell on why this move is very different than the June to August run, the left side of the V that we saw back then. Industrials have been on fire. I mean, when you look at XLI relative to SPY, it's basically it's a vertical move, right? So you look at Caterpillar, you look at Honeywell, all the stuff which should not actually be doing well if we're heading for a deep recession and everything the ultra bearish people are arguing. Again, I go back to from an intermarket perspective, underneath the surface, that looks wildly bullish. There's a message there.
Yeah, we upgraded the sector to an overweight on October 12th. And that was right when it was breaking out to multi-month relative strength highs. There's a lot going underneath the major indices, and I think a lot of people are missing that. The breadth of the market is actually improving dramatically. Companies that make earnings, are doing quite well. And when I'm saying make earnings, I mean companies that make product. They don't sell emotions. They don't sell communications. They literally make a product that everyone uses.
Yeah, and that relates to small caps, right? Which is a good transition. And I want to relate the small cap momentum discussion also to the point around zombie companies for a moment, right? Because there are a lot of zombie companies among these small cap averages, but there's a direct link between small caps and breadth, right? Because there's many more small cap names than large cap names. Just definitionally, it's Russell 2000, not Russell 500, right? So the fact that's been another interesting thing, which to your point, people are not really paying attention to. I keep on hammering it, saying, look at what's happening. They kept on focusing on, Amazon earnings and Google earnings, all this stuff. And it's beneath the surface, small caps keep on strengthening. From your cycle work, how do you view small cap strength at major inflection points? So the stuff that I've seen suggests that usually large caps will lead first out of a major bottom because there's disbelief. So investors want liquidity with larger cap names. Then as they get more comfortable, they go smaller cap because they're less liquid, at least in theory. But talk through to the audience, how important or maybe not important small cap strength is for a bullish argument.
Well, when you look at the market last year, the Russell 2000 peaked out in March. If you were looking at breadth at the time, you would have said, "Hey, something's wrong. It's only large caps going up." Right? That is the very thing that identifies a bubble. Right? Your breadth is deteriorating. I would say bottoms are made when your highest risk companies are going down no less than the rest of the market. Does that make sense? Here's an example. In 2008 in November, small cap biotechs made a low, and by the time March came around and the rest of the market made a bottom, on a relative basis they were up 100%. When you look at something like that, here's an area that's the most highest speculative area with no earnings, and I'm talking microcap biotechs. They actually traded up from November to March and we're up 100% versus the market. So if you looked at a relative strength line, you were sitting there going, something is going on here. And, so what I would say, when I threw out some charts today, emerging markets are outperforming Tesla, like that makes you think, if emerging markets are so bad, what is safe? The most loved stock in the world or emerging markets, and that is the differential and change that one needs to look at to keep their mindset right. Everything in the world to me is relative, and most of my fund managers are long only, so I have to put them into things that are going to lose in a bear market, lose less. It sounds contrary to what many people think of what a long only manager does, but if you hunt relative strength, and as you're going through a bear market, you're looking at charts that are 1 month relative strength high, 2 months, 3 months, 6 months, 12 months. We've done a lot of back studies where, for those that don't believe in technicals, we created some studies, for instance, buying groups hitting 26-week price and relative strength highs with a 20-week hold. If it hits a new high, you reset the clock for 20 weeks. We did it for 26-week, 52. We've tried it with 13. The longer the trend that's being broken, so the 52-week relative strength high list was by far the worst or the best in terms of performance, going back to 1969. Okay, and that's with true survivorship, not survivorship bias. So when you look at that type of work and say, does it lead you to the right places every time? It will, but you might be shooting with a shotgun instead of a rifle when it comes. You can't go out and buy every group out there that's hitting a 52-week relative strength high. But it always pointed to the groups that did it. And the question is to try to line up as a fund manager, line up the fundamentals and look for secular changes. And I think that's the most important thing. The other aspect is when you look at sector deviations, from 69. I think the last time we actually did this study was about 5 years ago. But, the average deviation on an annual basis between the best sector and worst sector. Now, our group work has 12 sectors, but the best sector minus the worst sector, you're at about a 34% variance. Okay. That's just on an annualized basis. Second best from the second worst is around 26%. So being in the top two sectors for the course of the year is significant to performance. And those are the things that I think investors lose sight of when they're day trading. You don't have to day trade. You can get into a secular bull market. We went bullish on energy January of 21. It's in writing. Relative strength was absolutely phenomenal starting in January of 21, a year before the actual, big drive up in terms of relative performance.
So on this point about secular changes, this is actually something that's kind of near and dear to me and has been admittedly quite frustrating for the last decade. So if you're going to do let's say a momentum strategy that's short, intermediate term, you still need to have a longer term secular trend favoring what you're trading in order to not have false signals when you're trading, based on momentum signals. So I always go back to the idea that everyone often references momentum as their trading style. Momentum worked beautifully for the S&P the last decade, worked horribly for emerging markets, right, which got whipped around and have gone nowhere, right? So I mention that because I always go back to this point that it's more than just signal. It's also about opportunity set, and you need to have the wind at your back for your signal to ultimately work, right? So I say all that because I think one thing that's a nuance and that's missed by a lot of the trading community is what do you execute your signals on, and how do you identify where the longer term secular trend might be to favor the signals working?
Yeah, and that is, secular changes don't happen every week, every month, every quarter. It happens over long periods of time, and I think we are getting to, when you look at this latest run, from the global financial crisis to where we were at the beginning of the year. If you looked at foreign markets, they did not enjoy any upside, zero. I mean, across the board, and you know, I'm seeing things like, you look at the ETF EWW, the Mexican peso is at 2-year highs versus the dollar. Despite everyone looking at the US dollar index, EWW is breaking a 12-year relative strength downtrend. To me, everything's relative. I remember in the 2003 to 2008 period, you wanted to own those countries with commodities, and that was Brazil, it was Canada and Australia. The problem is that Australia and Canada, their banking, sectors are much larger than their basic material sector, and that's weighing on them because they certainly have a mortgage problem. So, those markets to me are, wait and see how this pans out. But, Brazil was doing quite well for the last 6 months. But, again, I can't walk into someone's office and come up with a secular change every day because it doesn't happen. But looking at the US dollar now and looking at, the history from, the 2000 bubble, and by, the fourth quarter of 2002, you started a secular bull market in energy. And we have all of that in place for the same exact type movement in that sector. I remember in 1980, when I say I remember it, I was still in high school, but it was 30% of the market. Today, energy is 6%, and everyone thinks it's, a blow off. When you start to find sectors that are 30% of the market, in 2002, media and communications and technology was 52% of the market in terms of market cap weighting. And, that to me is a bubble. You start getting a sector over 30%, it's a bubble. I don't care what you say, it's a bubble. Get out.
You had mentioned the tech bubble. I mean, that's also when emerging markets started their own outperformance against the U.S. So, history may not repeat, but it does rhyme, that kind of cliche. I shared at the top of the nest a look at the 3-year rolling annualized returns of emerging markets, the MSCI Emerging Market Index, versus the S&P. Right. So if you're above, the emerging markets are outperforming the U.S. If you're below, the U.S. is outperforming. You can argue, sure, U.S. dominance will continue, but I want this relates very much to the name of the space, the end of large cap dominance. A lot of the reason you can argue why it was all about the S&P was because it was all about FANGs. Well, why was it all about FANGs? Because it was all about ZIRP, zero interest rate policy.
Absolutely.
Right? So there is an argument, I think, which is valid, that we are in the midst of a secular leadership change because the dynamics that underpinned that concentration of momentum in mega caps is no longer there.
Absolutely. I would agree with that. And the companies that will do better are your, your old economy companies. If you're a value fund and value's out of favor for 8 years, what do? You're underperforming, you're losing assets. And unfortunately, that is just it's the environment you're in. And unless you have an open end to, be able to regulate or move into value or growth, Apple was in the value index and the growth index, and I'm like, okay, well, how does one determine whether value is outperforming or growth? When you have that type of behavior. So I think we're in a secular change of leadership. When I go into rooms, and I've been in rooms with 500 people, and I say, I think the biggest upside here is probably the emerging markets, and I'm not saying it's today, tomorrow, next week. I'm saying when it turns, you'll know. And, how many people in this room, raise your hand if you think, or if you want to be in the emerging markets. You never get one hand. So, sometimes being the contrarian is the hardest thing to do. And I know you've taken flack from it. I've seen some of your postings that you posted on it where you get attacked. And you know what? I'm saying keep an open eye be friendly and ask questions. You're not going to bite them. I'm not going to bite you. If you have a question, I don't have all the answers. Like I said, even though I've been doing this for 35 years, I'm still a student. I have learned so much in these rooms. So I appreciate everyone that tunes in, asks a question. It's helpful to me to see the frame of mind of the masses. I go by charts, and if you don't like the way the charts are looking, I can't change them. To me, gold is reversing its downtrend. You got a head and shoulders bottom on GDX, GDXJ. You don't see it in all the metals, but Steel Dynamics, commercial metals, they look great. Those are the leadership right now. But things again take time to develop.
And by the way, I will say I think there is a co-movement that happens between even gold and emerging markets or commodities at large, right? Because there's a link to raw materials and the emerging economies. So to the extent that you've had weakness in EM and gold and commodities, well, it may make sense that if you're bullish on one, you should probably be arguably bullish on all three. And I think this is where this gets to be really, hopefully, positive for asset allocators because, as it's very hard to beat the S&P when the S&P is the only game in town, right? And this is something which is very nuanced, I think, in the way the last decade has really played out. So I'm not really a big believer in stock picking. I'll talk about stocks individually, I'll seeking alpha, but the reality is I'm much more academic in the sense that, if you want to beat the average, you have to choose the right average, right? You have to choose the right asset class at the right time. And hopefully you're not getting whipsawed in doing so, right? So to the extent that emerging markets have lagged for so long, that's been a drag relative to the S&P. You have any kind of momentum trigger there, doesn't work, failed. Same thing with small caps, again, relative to large caps. If you're entering a period where at least one of those outperforms the S&P, outperforms large caps, well, now that gets to be kind of interesting for those that have been, left for dead for a while, trying to quote unquote beat the market when the market's really just been five stocks.
Exactly. The weighting of the large caps, the Apples and Teslas of the world, which have really held the market up very well. I put a chart out on Tesla last week at $212. To me, it looked like and I highlighted another diamond pattern. And I said, this one looks bearish. To me, Tesla has a huge top on it. It doesn't mean it's not a great company. They don't have great products. They don't have a great, leader. It has nothing to, it's just the chart, leave it at the chart, and that's where I try to, hold steady is, look at what's going on around you. When you see something like the RCD, which is the unweighted, consumer discretionary index, is far outperforming XRT only because Amazon's the biggest company in there. I had done a call with George Noble back in April, and I said Amazon's done, and I think it's been close to cut in half since that time. Not trying to pat myself on the back. It is what it is. But there's so much love for companies out there that you can't convince someone that something's changing. And those companies that benefited greatly from the COVID lockdown saw, tremendous amount of money pull into them. I think the average individual is now, hey, I don't need to order something from Amazon. I'll go to my local store. There's a lot of individual retail stocks that actually are doing quite well and, have inflected bullishly weeks ago. And, those are the ones that we're looking at it on an individual basis. Names that, do better, for instance, when car sales are declining. Look at AutoZone and O'Reilly. That's something that we've highlighted a number of times. People go out and fix their car instead of paying, 9% on a new car. So, there are ways to navigate the market by looking at other periods in which you had higher, rising rates and the expectation of lower new car sales.
I feel like if we're going to talk about emerging markets, the question becomes emerging markets broadly, which would include China, or get more granular.
I think it's more granular. Korea looks good. India looks absolutely fantastic. It's probably one of my favorite markets aside from Brazil. And like I said, I kind of got a bad stain on Brazil with the elections, and, I'm kind of pulling back from that. I need to see how that plays out. So, it's looking individually and looking for those inflections in the currency and seeing what's happening. I mean, even Europe looks great right now, and no one would ever expect me to say that. So, If you looked at the stock 600, the Euro 50, they're the stocks 50, they're all breaking a relative strength downtrend versus the S&P.
Which again is important for asset allocation, because it's just unfortunately the entire industry benchmarks everything against the S&P. In the case of the tech wreck from 2000 to 2002, which is when commodities started getting a resurgence and emerging markets started outperforming, you had emerging markets have some pretty nasty drawdowns all throughout that period where it was still outperforming a volatile U.S. market. So talk about managing risk for a moment, because emerging market momentum looks very, very different than U.S. momentum.
Yeah, and again, I think it depends on what country you're looking at. I think we've been taught that again, when you start to have the riskiest areas start to outperform, the benchmark like the S&P, you have to question yourself and say, is there risk here, or can I buy a lot more emerging market for a lot less money when it comes to like the Korean won's down, I think 40% in the last 18 months. And one of the things is, if you're bullish energy, and you think we're going to go through a recession, I do think that a recession is probably likely. I don't think that the bottom we've seen is necessarily the bottom at this juncture, until we break the downtrend. But, you can't afford to have missed that leg off the bottom either. But I do think that we'll have some retests that will pull this market back. I think at some point we may take it out. And again, that may be through repatriation of funds by foreign central banks, by foreign investors, if the dollar were to precipitously fall like it did in 2012. But I think in the end, what you're going to have if the dollar is declining, remember this: foreign currencies will strengthen. It's going to rejuvenate their economy because now they have more buying power towards commodities. Okay. I don't think we resolved any of the commodity run. All we did is put it on hiatus with a strong dollar and bad policy. I think the Fed is more or less being put on the hook for bad fiscal policy. And that's what I see from my desk.
And I'm with you on that. And this is the thing. It's like, unfortunately, a lot of Twitter is countering what people think they're hearing, but in reality are missing the argument. This whole melt-up case I've been making was never meant to be a very long-term thesis, and nor was it meant to be me saying, I think the bottom is in. I've said many times, similar to you, that this is probably a larger, longer bear market that we may not have seen the lows, but yes, you can have these enormous runs between now and when the ultimate lows happen. To me, this is much more, I really do believe this. I think a year from now or a couple of years from now, this will be a fascinating period in terms of psychology and behavior. Because I keep going back to what made this year so abnormal is not just stocks and treasuries correlating in their dual drawdown, but again, the way that stocks went down. So I keep referencing that stat, 63% of the year, using weekly data, the S&P has lost money. The only other time you had that kind of persistence on the downside using weekly returns was 1931. So it really is true. I do believe this, that the market has conditioned people to be bearish. That's why I keep using that line, staircase down, elevator up this time, right? Because most bear markets tend to not have that kind of pattern. Most bear markets have, as you know, very big down, then you recover, then very big down, then you recover. But they're kind of concentrated declines, not consistent ones, right? I think that's what's sucking people into this belief that it keeps going lower from a trading perspective when all the intermarket stuff says quite the opposite.
Yeah. Well, and that's the problem. If you looked at the market back at that November low period, at the rate we were going, we would have been zero by December, right? I mean,
right, and long duration treasuries. It's like, this is the thing. It's like, this is why I kept saying, you got to save bonds, save the world. 30-year mortgage rates at the speed with which yields had been rising would be like 20% next month. You've already put a standstill to housing. So how much more damage do you need in the bond market to break the economy?
I've also had that conversation with you, on a few tweets that you put out that, I threw words in your mouth and I said, I hope I'm not, throwing these into Michael's mouth, but he didn't say it's a melt up and this is the absolute bottom. So I would agree with you. I think that we will go through, even when you look at other periods, whether it's 2000 or the 2008-9 crisis, markets didn't bottom for months even after the Fed started cutting. And I think that again, we'll get another period of apathy and everyone will get bared up again and we'll repeat, wash, rinse, repeat. That's what we're going to see.
And then the question then becomes, would you have more traditional risk off? Which, I keep going back to, this has been my hell. Only time in history, at least so far, and that's an important point, only time in history so far, where in a top 20 drawdown for stocks, treasuries have lost more than stocks. Now, I say so far because you've seen that chart I keep showing, top 20 drawdowns. Look at treasuries, even the 70s, it still acts as a relative safe haven. If the drawdown in stocks is not over, which I don't believe it is, it could very well be that treasuries in the fullness of the stock market drawdown from, when it started at the start of the year to the ultimate low, it could still be that treasuries look like a safe haven over the entire period, meaning you could see treasuries again act as a safe haven.
I would agree. If we start to see, yields come down aggressively, that's going to be a signal that it's the risk off and people are willing to accept the 4%, 4.13% on the 10-year, and they'll drive it down to, 3.8%. And then you'll know that the market is probably, at that point where, it's going to have a corrective action. So I do think they will become the safety haven. Fool me once, shame on you. Fool me twice, shame on me, right? But I don't think that we're going to see this play out the same exact way that we just, did. So I would agree with you. I think they will become the safe haven when this is all over.
Yeah, I mean, from your lips to God's ears. And this is actually a good discussion, too, because you've been around long enough to know this and see this. This is, I think, the only domain in life where you can be right and lose money and wrong and make money.
Absolutely. There is no, and that's what we're playing whack-a-mole. Is my father used to say, kind of like when you're, your millennials, all lived in your basement even when they were 27 years old, right? He would often go to meetings and say, relative strength works great. It's the 2%, 4% of the time that it doesn't, that it just absolutely slaughters you. And he used the term, it's like Hannibal Lecter. You can only live off of relatives for so long. And, it just, it's playing whack-a-mole. I mean, you look at the relative strength of utilities and, from the beginning of the year and look at those relative strength lines, every time you were popping out, you got whacked again. So, we moved our utility weighting down significantly, before the onslaught. But, to think that they would draw down to that magnitude along with bonds, no one predicted it, right? No one called the pension funds either. We all knew something was going to blow up. We just didn't have that on our bingo card.
Yeah, and I've kept on pushing back because I come out saying back in like March, it's like, this is worse than 2008, worse than 2020. I can promise you that if everything was marked to market, this would look like it's worse than 2008. How could it not be, right? Because look what happened with the UK. It's like somebody in a YouTube comment on a podcast, said, "Oh, you haven't seen a single company go under. What are you talking about? It's worse than 08." It's like, what are you talking about? You almost had the entire country, the entire United Kingdom go under.
You know what? It felt like that. But again, like I said, you look at microcap biotechs in November of 2008, they were up 100% relative to the market. And, that's the most speculative area of the market. And you know what? They peaked out the day of the bottom. So, money will find its way into things that are not rational. And you have to pay attention to it. And you can say, hey, I don't believe it. It's not happening, but it is. And unfortunately, the behavior of the market at times like this is frustrating. It's frustrating for everyone. We have a secular trend going on, but no one wants them because everyone's gearing up that we're going to have a recession. But, if the dollar comes down, you're going to see emerging markets have a hell of a lot more buying power for energy that they didn't have for the last 12 months. Yeah. There's a confluence of events that, could occur even if the U.S. goes into a recession, the largest, consumer of oil in the world.
How do you think about the high yield junk debt on a go-forward basis? And I'm asking that because that's been also one of those strange dynamics, right? That which is conservative, has done worse than aggressive. In other words, AAA, BBB bond funds, right? They're trading below their COVID crash levels, whereas high yield junk debt funds are still above their COVID crash levels. If there's opportunity in bonds because now there's actual yield, Does it make sense to go into high yield, or maybe play the dislocation that I think is there with the quote unquote more conservative type of bonds?
Yeah, and I to be honest, I looked at the HYG and JNK, and I knew them well a year ago. I don't know what the makeup of what is in those particular ETFs. Are they energy companies? I would imagine the energy companies are lifting these up pretty well. And I know that at one point, energy was a huge weighting, back in 20. So, it's I would have to go back and sift through to see what the durations look like. You take something like the LQD, for instance, versus the TLT. The duration on the LQD, I think, is 5.6 years. So you have a lot lower duration. But what's amazing in a time like this, I have never seen something like a Goldman Sachs near relative strength highs versus the market. I mean, it is absolutely uncanny. And I threw this out on my Twitter page earlier this year, back probably in March, April, going, hey, this is a bullish inflection. As a matter of fact, Goldman Sachs versus the S&P 500 right now is at a relative strength high going back to the first quarter of 18.
Yeah, I'm seeing it myself now.
I mean, when have you seen that?
And that's not bearish. That's
exactly
what I'm saying.
Exactly.
Why is it that things that seem obvious, from a technical perspective, why is it that even though you can show these charts, people just are slow to change their minds? Because it's almost like there's a disbelief. People are so entrenched in their narrative.
Here's the problem. Tech becomes such a large weighting, and I was looking at the video today of someone out there that was talking about Upstart when it was at $350 and saying he bought the company, is up 25% in 4 days. People become myopic, and they don't want to own things outside of tech, because that's what you wanted to own for the last 5 years. Whether you got out of the COVID bubble or even prior to it, energy was faltering from 14 to 19 anyhow. That wasn't a sector you wanted to look at. You certainly didn't want commodities of any sort. So people have been conditioned to say tech is leadership. I don't recall any TV. Tech is disinflationary. I can go out and buy a 65-inch Samsung today for a fraction of the price it was 3 years ago. It's never gone up. It's never gone up. Tech never goes up in price. Services go up every year in tech. Problem is there's going to be a lot less companies around to purchase those services, is my belief.
Yeah, I'm sure in the nest, I just put the tweet out. Credit to you, obviously, on that, because I hadn't looked at Goldman Sachs specifically, but I mean that's insane, for lack of a better way of saying it. But this is again, this is my point. There's so many things happening beneath the surface. And then you've got the other factor, which is seasonality. And I want to hear your thoughts on how you factor in seasonality. I'm a big fan of Jeffrey Hirsch, Stock Traders Almanac. Best 6 months, midterms tend to be the best period. I've seen all kinds of data that says, well, except in a bear market, that's not the case. I think there's a lot of nuances we can discuss there. But how do you think about seasonality when you apply your framework around different charts?
Well, we did a seasonality report on every group in our product, and we have 444 groups. And we did this going back to 1969. I mean, the place that I want to see bottom before I actually can say the market has bottomed is the consumer discretionary. The consumer accounts for 70% of the market. But going back to the seasonality point, one of the best performing groups that had the most substantial seasonality was the game companies, like your Hasbro, Mattel, and you wanted to buy them right just before Christmas and hold them for the first 4 months of the year. You did that with most consumer-related names. That has a tendency to be the best area for seasonality from a 69 to present perspective in terms of momentum, reversals, and upside relative to the overall market. So those are I don't spend as much time on seasonality as just going through, because I think you lose sight of the seasonality have, and I'm not saying it's not useful. I only have so much time in a day, and I can't go back through all that work and look through thousands and thousands of data points. So I love that you have done that. So I'm going to ask you with seasonality questions for now on.
Yeah, I mean, again, I think it's just one of those things where it's like I keep going back to, and at this point, like I stopped correcting people on it because people will say I made a call on a melt up, and I can see why people would say that, but I would go back to at my core, it's about conditions, probabilities, and an outcome. Right. So between the conditions of the seasonality side, utilities weakness at the end of September. Okay, admittedly, it's strengthening again. Fine, but again, sentiment, small caps. There's enough there where it's like a weight of the evidence approach. Right now, this may be a good place to a good question to kind of finalize the space here. But the question I keep getting, and I'm sure you've got some thoughts on this, is when does this end? Let's assume that we're in a melt up. When does it end? What's your target? And I don't really believe in targets. It's just to me, it's like if you have to reassess when the conditions change. As long as the rolling conditions are still there and present, that still favors the outcome. Continuing right in terms of a higher move. But for you, assuming that we're in this bull run, whatever you want to call it, melt up, what would be some of the signs that it's time to get more defensive?
Well, I like I said, I think bonds will become the safe haven this time. And so if we see a rush into bonds and start to see an inflection where we start moving down, below the 4% level, for instance, on the 10-year, I think that would be a sign that we're probably getting much closer to the top in this particular move. My time horizon, for the move, I think that it's probably at least an 18-month debacle. So we won't see, the potential bottom for another year. I think that we will undercut the lows. When they come for everything, you'll know. And what's when and going back to that Goldman Sachs comment, you look at Raymond James. Raymond James is at all-time highs. I mean, it's uncanny, but I need to see, again, what the money is flowing into now. I need to see that also pull back. I need to see utilities start to rise again. I think they will become the risk off sentiment indicator along with bonds.
This was a real pleasure. Again, I find myself nodding my head. I know it's confirmation bias, but I've been getting this has been a brutal year for me on a personal, professional level. I'm getting louder on Twitter because I just don't give a shit anymore. I know that I know what I'm seeing. I know the conclusions. I've seen this kind of behavior before. So I'm optimistic that we are at the cusp of some degree of normalization from the anomaly of this year. That doesn't mean the bear market's over. It just means it's going to look a little bit more familiar. Very good, everybody. Thank you for joining. Thank you, David, and enjoy the rest of your evenings. Thank you, Dave.
Thank you, Michael.